Here we deal with flexibilities that need to be allowed in dealing with or determining the kind of entities to be allowed to play roles in the inclusive insurance market. Flexibilities need to be allowed because there are entities that can play roles which may not be relevant in the conventional insurance space. And so if we disallow those flexibilities, we would be providing or building unnecessary barriers to inclusive insurance products to those who need them. So some of those flexibilities actually revolve around entities like mixed entities, small entities, composite insurance entities, pilot schemes, and dedicated insurance entities or dedicated micro insurance. I will take each of these and briefly explain what they bring to the table and what we need to look out for in allowing them or making room for them in the inclusive insurance space. So mixed entities are entities that provide both insurance and non-insurance services. A clear example would be an agricultural mutual, which also operates an insurance scheme to protect their members. So this will be an agricultural mutual that is mainly into agricultural business, um, taking care of the interests of members who are most likely to be farmers. But because they need insurance, they set up a scheme to also protect the interest of the members. So in that case, that mutual would have its agricultural business and have its insurance business as well. The key issue here is to ensure that we protect the insurance scheme from the risk from the agricultural business, especially mingling of funds and segregating the insurance assets and other relevant separations that need to be done. That is the main risk there. The main risk there is to making sure that we protect the insurance funds and resources from the other non-insurance resources. The other entity is small entities. These are insurance entities that are so small that they may not be appropriate in the conventional insurance space. In the inclusive insurance space, there should be space for small entities. However, we need to be able to determine, or there has to be some criteria for determining what is too small, because below a certain size, it will be really difficult for an entity to operate as an insurance entity. For example, the entity needs to be not too small to be able to adequately pool risks. So we need to make sure that the entity has what it takes to at least pool risks so that it will be able to spread that. Remember, insurance works on the law of large numbers. So if the numbers are smaller than a certain size, it's going to be technically difficult for this entity to offer the needed services efficiently. There are actually mechanisms for determining what is too small. We could use some actuarial techniques, which may be referred to as stochastic services, or we could be doing some benchmarking with other jurisdictions or even entities within the market. We could be looking at operational capacities to determine at what level does the business become too small to be viable. So small entities need to be accommodated, but we need to make sure that we can determine what is too small to be viable so that we don't create problems in the market. Composite insurance entities are entities that offer both life and non-life insurance products and services. In most jurisdictions, or in a number of jurisdictions, the insurance legislature prohibits composite insurance structures. And even in jurisdictions where this is allowed, there are strict rules about separating the life and the non-life funds and assets. Because of the nature of inclusive insurance, it should be possible for the legislation to allow composite insurance structures as far as inclusive insurance is concerned. However, the risks are not eliminated. And so there should still be rules on how to separate the funds and the asset so that we don't create mismatches and we avoid contagion between the two funds. Pilot schemes are also often used to test new ideas, products, and services, and it should be possible for the legislation to allow the use of pilot scheme because usually they are used to test the efficacy and the viability of innovative new ideas to improve the efficiency of the market, to reduce costs, and to improve quality of services. So pilot schemes should also be able to be allowed. There are, however, rules. There should be rules around who is allowed to pilot, for how long they should be allowed to pilot, the extent to which they can pilot, how we can manage the risk, how to disclose information to potential consumers and customers that this product or service is on pilot so that they get to understand what they are buying and what's going on. Dedicated insurance companies, or entities that do only, say, micro insurance. So it's dedicated to just one line of business. This should be possible to set up and operate and manage. And it should be possible for the legislation to lay out the appropriate rules to allow this. We, however, need to take appropriate steps to minimize regulatory arbitrage because once you have dedicated micro insurers, of course, they would have adapted requirements when it comes to licensing, when it comes to prudential requirement, when it comes to market conduct. But then there should be appropriateness and it should be applied and implemented in such a way that we would minimize arbitrage between the dedicated entity and the conventional insurance market.